It's Tuesday evening, December 30th, 2025. Most people are thinking about champagne and countdowns. I'm staring at my terminal watching the silver market, experience what I can only describe as a structural failure that almost nobody in the mainstream press understands. Let me show you what I mean. Right now, if you flip on any financial network, they're selling you a very specific story. They're pointing to yesterday's $8 crash, December 29th, and calling it the end of the silver bubble. They want you to believe the fever broke. The CME hiked margins, the speculators got flushed out, and now silver is sitting at $76.21, simply returning to normal. The danger is over, they say. The shorts won, the squeeze is dead. But while everyone is staring at those red candles, there's a number flashing on my screen that tells me the exact opposite story. The price dropped $8. But the cost to actually borrow physical silver for 30 days just hit 8.5%. Let me say that again. Someone, somewhere, is so desperate for silver right now that they're paying an annualized interest rate of 8.5% just to rent it for a month. That's not what a burst bubble looks like. That's what a liquidity crisis looks like. I'm a private commodities analyst. I've been stacking physical silver and trading these markets for 12 years. I built this channel because I got tired of two things. First, waiting 12 hours for Bloomberg or CNBC to report what I could see happening in real time on the terminal. And second, watching all these AI avatar channels pump out fake hype and garbage information about silver just to chase clicks. I use this AI avatar for one reason: speed. I can get real analysis to you faster than I can edit and upload a traditional video. The avatar is just the suit. The analysis is mine. And tonight, I need to walk you through something that most retail investors will never see reported anywhere else. Here's my core thesis. An 8.5% silver borrow rate, combined with yesterday's forced liquidation, proves that despite the price crash, physical metal is dangerously scarce and the spot liquidity system is breaking. When the cost to rent an asset explodes while the price of that asset is falling, you're not watching a market return to normal. You're watching a trap close. We have a massive disconnect. Paper silver, the contracts traded on COMEX, is being hammered down by regulatory margin hikes. But physical silver, the actual bars needed for industrial use and delivery, is vanishing from the vaults. Tonight, I'm going to explain the mechanism behind this 8.5% explosion. I'm going to run the math on what this means for the structural deficit. And I'm going to share my personal battle plan for the next 48 hours as we head into the January 1st China export deadline. By the end of this, you'll understand why the rejection at $84 was an artificial ceiling, and why the floor at $75 is being defended by the most desperate buyers I have seen in my career. But first, let's look at the battlefield. As of this evening, December 30th, silver spot is $76.21 per ounce. 24 hours ago, we were testing $84. I was watching it live. The chart printed a massive shooting star candle on the 1 hour time frame, a violent rejection that signaled a huge wave of sell orders hitting the market. This wasn't organic selling. This was the CME group stepping in on December 29th and hiking margin requirements. That move forced smaller traders to liquidate their positions because they couldn't afford the collateral to hold them anymore. The result? A volatility shock that sent us plunging towards $75. But here's what matters. Every single time the price touched $75 today, it was met with massive buying support, high volume, aggressive bids. The paper sellers tried to break through that level, and the physical buyers stood there with buckets, catching every ounce. Meanwhile, gold is holding firm at $4,338.29. Platinum is showing strength at $2,171.85. The paper price says silver is worth $76. But if you actually try to source a 1,000-ounce bar for immediate delivery in the wholesale market, you're not paying $76. You're paying a massive premium, assuming you can even find one. Here's the context most people are missing. 2025 is now officially the 5th consecutive year where the world used more silver than it mined or recycled. This is a structural deficit, not a temporary imbalance. The warehouses aren't just low, they're reaching what I call a zero-liquidity breaking point. And that brings us to the number that keeps me up at night. The 8.5% borrow rate. This is the smoking gun. It tells us the shorts are trapped and they're willing to pay anything to avoid a total default. Let me teach you what this number actually means, because understanding this mechanism is critical. The silver lease rate, also called the borrow rate, is the interest rate a party pays to rent physical silver bars for a specific period of time. Usually a bank, sometimes a large industrial user. They're paying for immediate, temporary access to the metal without buying it outright at the spot price. In a healthy, liquid market, this rate sits around 0.5%. It's a rounding error. It's nothing. Today, it's 8.4756%. Here's the analogy I want you to hold in your head. Imagine a car rental agency. Normally, renting a car costs $40 a day. You don't even think about it, But you show up one morning and they tell you the rate is now $400 a day. You'd walk away, right? You only pay that extortion level rate if your own car is totaled, you have an emergency meeting 100 miles away, and there are literally no cars left for sale anywhere in the city. You pay the $400 because you have a contractual obligation you cannot break. That's exactly what's happening in the silver market right now. The 8.5% rate means the shorts, the people who sold silver they didn't actually have, are so desperate to fulfill delivery notices that they're renting silver at 16 times the normal cost just to kick the can down the road for 30 days. This is the trap. When lease rates spike while prices are being suppressed, it means the physical supply is disappearing. If there were plenty of silver sitting in the vaults, the lease rate would be zero. The fact that it is 8.5% tells us that all this talk about market liquidity is a lie. The market is in desperation mode. Large players are paying high interest just to hold a bar for a month, hoping that by February, more supply magically shows up. But as I'm about to show you, that supply isn't coming. In fact, it's about to be cut off entirely. Let's run the numbers on what I'm calling the desperation gap. Conservative scenario first. Even if we assume the rumors about empty vaults are exaggerated, the Silver Institute has confirmed that 2025 will end with a deficit of roughly 200 million ounces. To bridge that gap, the market relies on registered stocks in the COMEX and LBMA vaults. Throughout this year, I've watched those stocks dwindle month after month. At an 8.5% lease rate, a market participant is paying roughly 54 cents per ounce per month, just in interest to rent silver. Think about that for a second. If you're a bank renting 10 million ounces to cover a short position, that's a $5.4 million monthly bill just to stay in the game. That's not a sustainable business model. That's a bleeding out scenario. Now let's factor in the China variable. Beijing has officially confirmed that starting January 1st, 2026, which is less than 36 hours from now, new export licensing requirements for silver will take effect. China controls between 60 and 70% of the global refined silver supply. If that export door slams shut, the 200 million ounce deficit could instantly double. We're looking at a math problem where the demand side, solar, electric vehicles, AI infrastructure, investment, is an immovable object, and the supply side is a shrinking shadow. The numbers simply don't work. You cannot have a 70% supply tightening and a 200 million ounce deficit while maintaining a paper price in the 70s. The only way to balance this equation is through a massive price reset or a force majeure event. Here's the gap that keeps me glued to my terminal tonight. The market is currently pricing silver as if the China export ban is a nothing burger, but the lease rate is pricing it as if the world ends on Friday. This is the widest disconnect between paper sentiment and physical reality I've ever seen in my career. Now, if this is so obvious, why isn't everyone buying? Because the skeptics have a very different theory, and I need to address it head on. The strongest counter-argument to my thesis is what I call the refining bottleneck theory. The skeptics say there's no geological shortage of silver. Instead, they argue that the record prices we hit above $80 triggered a massive wave of scrap silver hitting the market. Jewelry, old coins, silverware, grandma's silver set. This surge overwhelmed the refiners. Therefore, they claim the shortage of 0.999 investment-grade bars is just a temporary logistics backlog. Once the refiners catch up, the lease rates will crash, and the price will fall back to $50. Here's my rebuttal. Yes, it's true that scrap silver increases at high prices. That's economics 101. But refining capacity hasn't shrunk over the last 3 years. It's expanded. More importantly, scrap silver doesn't explain why industrial users are paying 8.5% lease rates. Solar panel manufacturers don't use grandma's spoons. They use high-purity silver paste, and they source that through long-term contracts with refiners. If the refiners were truly the only bottleneck, we'd see lead times increasing, not lease rates exploding. Lease rates explode when there's no raw material to begin with. And here's the myth I want to destroy right now. The media keeps saying the CME margin hikes on December 29th killed the silver rally. That's only half true. Margin hikes kill leveraged paper traders. They do nothing to stop a solar company from needing 10,000 ounces of physical metal to keep their factory running. In fact, margin hikes accelerate the physical squeeze because they force the weak hands out of the paper market, leaving only the strong hands who actually want delivery. The skeptics are watching the paper exit. I'm watching the physical entrance. So what happens next? Let me recap where we are. The price is $76, but it's finding massive support at $75. Borrow rates are at a 20-year high of 8.5%. The CME has hiked margins to flush out speculators, but the physical deficit remains. Here's what I'm watching in the next 72 hours. First, institutional reaction. Watch for a potential media blackout or a shift in narrative. If the China export ban goes into effect on January 1st and silver prices don't immediately skyrocket, the media will call it priced in. Do not believe them. Watch the lease rates. If the price stays flat, but lease rates climb toward 10%, it means the institutions are cannibalizing each other behind the scenes to find metal. Second, the rumor mill. Keep a close eye on industrial force majeure rumors. There are unverified reports circulating that a major solar manufacturer is about to declare they cannot fulfill orders due to a lack of silver paste. If that rumor is confirmed, the paper price becomes irrelevant overnight. Third, the dashboard indicators. These are the specific numbers I'm watching on my terminal tonight. The $75 level. If this breaks on high volume, the skeptics might be right about a deeper correction. The 8.5% lease rate. If this starts to drop back toward 1%, the immediate physical panic is over. If it stays high, the fuse is still lit. And the Shanghai Gold Exchange premium. Watch if the price of silver in China starts trading at a $5 or $10 premium over the New York price. That's the arbitrage that will drain the West of its remaining metal. But here's what really keeps me up at night. What happens when the paper shorts can no longer rent their way out of the hole? I want to be very clear about something. I'm not a financial advisor. I'm not telling you what to do with your money. I am simply sharing my personal battle plan and exactly what I'm watching as we head into the new year. I'm focused entirely on two things: the $75 support level and the China export implementation on January 1st. To me, these are the two pillars of the current market. Here are my conditional actions. If China's export ban appears to be a total hard stop on January 1st, I will personally be looking to increase my physical silver exposure on any dip toward the $72 range. I believe the structural deficit is too large for the market to ignore if the world's largest refiner stops exporting. If silver retests the $84 wall and fails for a second time, I'm sitting on my hands. A double top at 84 would suggest the CME's margin hike successfully broke the momentum for now, and I'd wait for a much deeper correction toward the $68 to $70 range before taking any further action. If I see the lease rates crash back to 1% while the price is dropping, I'll interpret that as a sign the physical squeeze was a temporary logistics glitch, and I'll personally look to move to the sidelines until a new trend emerges. I'm not guessing. I'm waiting for the market to prove its next move. I'm watching the desperation premium in the lease rates more than I'm watching the candles on the screen. To wrap this up, silver is at a crossroads where a $76 paper price is fighting an 8.5% physical reality. The CME tried to cool the market with margin hikes, but the impending China export ban on January 1st is a black swan that cannot be ignored. We're watching a 5-year structural deficit finally meet its breaking point in the lease markets. I believe the next 48 hours will determine the trend for the first half of 2026. The screen is telling you to panic and sell, but the vaults are telling you that someone is paying a king's ransom just to hold the metal for a few more weeks. The pressure is building and the system is cracking. If you want to understand the history of these lease rate spikes and see where this ends, go watch my previous deep dive on the 1980 silver squeeze. The similarities in how the exchange rules were changed when the shorts got trapped are eerie. Understanding the past is the only way to survive the present. The end of 2025 isn't the end of this story, it's just the beginning of the real squeeze. I'll see you in the next one.